So Jerry, Adam, Tom, thanks for joining me today. Jerry, if we could start by a brief introduction to who you are and what your role is at Leon Herman, that would be great.
Thanks, John. Yeah, my name's Jerry Scriven. I'm the Managing Director at Leon Herman. We're a firm of accountants based in South Manchester. We have a strong focus on advisory services, so we've got significant real-world experience amongst our senior team, where we've actually worked within relatively large corporates. So in that sense, we're well placed to advise our clients who typically are kind of growing owner-managed businesses, but they have they do have a desire to create capital value in most cases. So we can empathise with them, both in the fact that we've been there and done it and walked a mile in their shoes. Also, we're invested in our own business. We've got some of those kind of risks every day that they're facing. So that works well for us. But of course, we also offer a high quality compliance-based service, which is feedback we get is timely and efficient. And for a lot of businesses, that's all they want from us at certain times. And as businesses' life cycles change, then when we talk to them about what the art of the possible might be, then their view might change, and we can provide additional services. So I think moving forward, we will be doing more on the advisory service, and in particular, we're offering an outsourced finance function for businesses, whereby effectively we say to business owners, you do what you're good at, and we'll pick up on the finance side, and we can support you. And the ultimate aim of that is to make ourselves redundant, because the business grows to a size where they can afford to invest in a strategic sort of CFO type person. So it's kind of working well, and we need to get the right team around us, and we're there now with that substantially. Obviously, attracting talent is a challenge for all of us in these days, but we have the internal resource that's aligned with our external client needs.
Great, thanks, Jerry. So we're also joined by Adam Norris and Tom Hoban from Reflect Financial. So if you guys could just give us a brief overview of your roles in Reflect Financial, that would be great.
Before you do, Jerry, just be careful about going too far away from the mic.
Okay.
And then you guys obviously just be aware of being close into the mic.
Yeah.
Right.
Okay. I'll ask again. So we're also joined by Adam Norris and Tom Hoban from Reflect Financial. So if you guys could just give us a brief overview of who you are and Reflect Financial, that would be great.
Okay, no problem. So I'll begin. I'm a financial planner at Reflect Financial. Reflect Financial is a firm of financial advisory. It's a financial advisory firm. What we do is we provide advice and guidance to a wide range of individuals, really trying to help them with their forward planning, their financial security, achieving what they want to do in their life. We're quite a large firm, so we have a wide range of experience, skills, advisors with different backgrounds and different perspectives. And similar to Jerry, what we try and do is we provide the services and the support for people to focus so that we can do the bit that we're good at, and free people up to specialise and focus on their careers and their families and what they want to spend their time doing.
Great, thanks.
Yeah, just to add to that kind of further on from what we spoke about earlier, the industry that we're in has changed a lot from just managing clients' money to actually focusing on goals, what you're trying to achieve. And one of the reasons we're sat around the table today is to have a conversation around that. And in a business perspective, with a business owner, it's not just around growing the value of the business for the sake of it and for business growth. It's more so around, from a personal perspective, what you're trying to achieve, why you're trying to achieve it, and our job's to put a bit of context around that and make sure the business goals align with the personal goals as well.
Great. So, as we said in the introduction, the aim of this masterclass is really to take the business owner's perspective from business owners who might be considering a sale in the relatively near future, or perhaps a long way away. So as I said in the intro, the aim of this masterclass really is to take the view of a business owner and those who might be considering a sale soon or perhaps many years away. And what I'd like to do is take the journey from pre-exit to exit and then post-exit, and I'll get your perspectives on that. So I'd like to start really from the business owner's perspective, perhaps a business owner who is contemplating a sale in a few years' time, and really to understand what they need to do to start strategically building their business value, and then also on the personal finance side, what you would recommend they should be doing. So, Jerry, I'd like to start with you if that's okay. And I guess the first question is quite simple, and that really is, from your experience, when should a business owner really start preparing their business for sale?
Well, in a perfect world, they'll start to prepare their business for sale when they launch the business. You know, it's absolutely start with the end in mind. Clearly, in the vast majority of cases, that doesn't happen. But ultimately, you know, within our client base, we've got kind of what you'd call serial entrepreneurs. So ultimately, once you've done it once and then you look at something else, you would do that. The reality is that where a business is looking for our help and support, you know, we would like at least a 3-year kind of timeline to move the business from where it is now to where they might like it to be, and it typically might be longer than that. And it's a relatively simple process to kick that off. It's kind of, you know, where have you come from, where are you now, and where would you like to be? Now, within that, there are all sorts of drivers and considerations that kind of will impact on the business performance. But essentially, what we do from the point at which we are engaged is to work to fill what we would call a data room. So these are kind of all of the boxes that you need to tick when it comes to looking at an exit, and actually, you know, there's performance-based financial metrics, other softer non-financial metrics, kind of legal considerations, lots of work around people. So the basic level, making sure you've got the right kind of contracts, etc., in place, but moving up to the more value add stuff, people, you know, key people, all people having personal development plans, etc. So yeah, that's the kind of, you know, that's the perfect start.
So really,
but the realistic.
So you're saying start to think about sale really when you set up, or are you saying that all of these things that you're going to speak about later today in terms of building value, business owners should really be doing that anyway, whether they want to exit the business or not? It's just good business.
Well, absolutely.
sense.
I mean, you know, clearly there are a group of businesses that might fall under a lifestyle category, and that isn't meant in any derogatory sense. That's absolutely fine. You know, people know what they want out of a business, and it might not just be, you know, huge financial reward. There might be other things that are driving them, particularly, you know, given some of the challenges we faced in life. A number of people are kind of reassessing their options, and we saw a number of people disappear from kind of workforce, didn't we? So but actually, yes, even if you aren't really looking at an exit position, all of these good business practices and principles that every business should strive for enables you to create value, whether you're looking to capitalise on it in one lump sum, but it just gives you flexibility in terms of other things that you want to do. And of course, on an annual basis, those business owners will be wanting to talk to Tom and Adam to understand how best to manage their finances with some of the kind of simple things that you know much more about, like the, you know, pension, making full advantage of your tax pay. But if you haven't got funds in the business to do that, then it's kind of it's all hypothetical. So absolutely, whether you are or aren't focused on an exit, just delivering good business principles and practices to maximise profits and cash should be at the foundation of every business looking to trade as well as it can do.
Great. So I guess as a business owner then, who perhaps doesn't know how a business is valued, could you give me a brief overview of how you value a business?
Yeah, in very simple terms, the starting point for us when we're valuing a business would be calculating a maintainable profit figure, which is known as EBITDA. You might have heard that phrase, but essentially it's an adjusted maintainable profit figure to compare most businesses like for like without having complex tax structures and funding structures and how you buy your assets involved. So that they're all extracted, and then normalising certain other costs and expenses to get to a maintainable profit, i.e. a profit that you can deliver kind of year on year without exceptional items within it. So that's one element. The other element is a multiple, and the multiple essentially is kind of a number that you apply to the profit, and that would give you the overall enterprise value, so the business value before adjusting for debt and excess cash, etc. So that's what we usually work towards, is the enterprise value. And then that multiple is a function of many things, and probably one of the biggest things is size. So our businesses are typically kind of SME type businesses. So most of the multiples, in our world would range between 3 and 8, sometimes higher when you're working with kind of probably more tech-based businesses where there's a kind of a slightly different market, but they are outliers for us, and obviously what we're striving to do is to understand where a business currently sits and both move that multiple further north and also the maintainable profit figure further north, and obviously that's the equation, so that increases the overall business value.
Great.
And there's a point in there, Jerry, as well, which links to kind of our side of the equation as well, with the personal business element that you talked about. Building that view of the maintainable profit helps. So the closer an individual is to that, whether they're trying to build value to sell or not, having a close view on that maintainable profit allows them to plan more consistently in terms of how we extract benefit from the business through the journey, through that life cycle as well. So I think it's like I say, it's principles to keep in mind, just for good business practice.
And that's a really good point, Adam, because we see a lot of times where essentially a business owner gets used to a package, that's how they adapt their life. Now, oftentimes that's substantial, and the business it needs to be more than ticking over to maintain that, and you do see circumstances where the business doesn't keep up its performance, but the owners are still having the same lifestyle, and that is not a recipe for long-term happiness. So it's a really good point.
So that's interesting. As we said right at the outset, there's going to be elements of crossover, and clearly maintainable profits is a key driver of value, EBITDA. So if I was going to ask you what EBITDA is, because there'll be people sat there listening to this thinking, I don't know what that means. Are you able to give a quick overview of what EBITDA is, or at least what the letters stand for?
Yes.
So if you don't want to.
Someone Google it quickly.
EBITDA stands for earnings before interest, tax, depreciation, and amortization. So essentially, going back to what I said earlier, it's trying to work on your operating profit really. So interest, obviously that's a function of the way a business is funded. So business A might have 2 million quid's worth of debt in it, and business B might be funded from its own reserves, so they'll have different interest figures. And then tax, corporation tax predominantly depends on things like capital allowances, where you're operating, these kind of things. So not everybody is, you can make the same profit and have a significantly different tax charge. Depreciation is obviously it's an accounting adjustment which recognises the fact that an asset has a useful life. So if you buy an asset for £500,000 and it's got a useful life of 5 years, in very simple terms, £100,000 will get allocated to the profit and loss account to reflect the fact that that asset is having diminution in value.
Mm-hmm.
And amortization is kind of a sort of typically it's depreciation, but often it will be on things like goodwill. So if you buy a business, the difference between the asset value and the actual price you pay for it's called goodwill, and that then will again there's a time period over which that will diminish, and so that's amortization, similar to depreciation in that sense,
Mm-hmm.
another accounting entry. So that's the
That's what it stands for.
Yeah, very exciting kind of technical definition of EBITDA. Yeah, but ultimately, in our world, that's kind of maintainable profits. Yeah.
So clearly, for a buyer, maintainable profits into the future is a key driver of how they'll value your business. If you were talking to a business owner, a client of yours, and they needed to improve their financial performance, what sort of elements would you be telling them to be on top of, or to be able to demonstrate to a potential buyer?
Okay, so are we talking the EBITDA element
Yeah,
here,
I'm thinking
or the multiple element?
No, I'm talking the EBITDA earnings side of the business. What sort of figures should they be looking at or on top of?
Yeah, so I mean, well, essentially, it's almost as simple as turnover, margin, and then cost. So margin being the mix of sales that you're going to have, and then the costs, the I suppose non-direct costs that you need to incur to deliver that turnover. That's a fairly simple answer, but that's the reality. I mean, clearly, that behind that, there's a lot of work that needs to be done to sort of increase turnover, improve the mix so that you've got the right kind of, you're improving your margin, and then clearly, costs. It's interesting on the cost side, because if you're in growth phase, you are always reinvesting and investing, so you're not always getting a return on those costs.
No.
On month one, might be year one. So there is a kind of a different mindset there, because if you are running your business from year to year, then you probably you're investing in the same way, but you kind of you are looking for a return probably more quickly. So there's a slightly different mindset there. The other thing that absolutely it doesn't change change those drivers, but it helps you make decisions to change them. Is getting accurate management information out very quickly after a period end. Not a lot of value, I don't think, in having sort of quarterly accounts produced. So it's better than doing it 12 monthly. But if you definitely a business in growth phase and looking to improve capital value, if something happens on day 2 of a quarter and you don't find out until a month after the end of the quarter, because that's how quickly you get your management, you've got 4 months worth of whatever it is that's going wrong before you can start to address it. So we would always advocate monthly MI and actually reporting on that quite quickly after the month end. You might not have it to the pound, but that isn't what you need your management information for. You just need, it's by exception, you need to know what's working well and what isn't, and having a traffic light system around that. And then I guess the other summary is it's not always, it's that whole kind of point about turnover's vanity and profit sanity, isn't it? And you don't have to be turning over millions and millions of pounds if you've got your margins right. In fact, it's better to turn over less with a higher margin, and with a very controlled cost base. You'd expect there to be much less risk in a business like that.
Great. So then let's talk about the multiple. So we've covered the financial side of valuation, and I'd like to get onto the multiple that you mentioned before. So a phrase I've heard a few times is this idea of a market valuation multiple, because you've mentioned that businesses could be sold anything between 3 and 8 or 3 and 7 realistically. So I'm just interested to understand what is the role of the market valuation multiple? What does that mean to a business owner?
Well, I think in large corporate world, kind of the multiple essentially is where you're buying a multiple of future profits in your business valuation. So that's the significance of it. You have to say that again, if you're comparing sort of large corporates with our typical client base, you're not comparing like with like, and that's reflected in so a multiple in a large corporate will be significantly different to a multiple in a a nimble but smallish growing business in an interesting sector, and in those kind of high quality large corporates, the multiple will be significant double digits sometime, whereas that's not the case with our client base, but the multiple itself is driven by internal factors and external factors, and essentially the way we would sort of categorise that. So the internal factors are something that you actually could probably do something about. Some of the external factors you can't. The market that we're operating in, whether it's generically or specifically in your sector, you can't really influence too much. We've had a couple of examples recently with businesses that we've been working with, which are really good businesses and have got a very nice kind of positive trend in terms of turnover and profit. They've stalled, and they're kind of over the last couple of years they're in the what I suppose broadly the consumer discretionary spend sector. So given some of the economic headwinds we've all been facing, and uncertainty around disposable income and etc., that people have stopped kind of spending on things that they don't have to spend on, and particularly the online, the e-commerce world has seen significant sort of slowdown in most areas. So not much a business can really do about that. But internal factors would be things like quality of the management team, having good quality people and a good breadth of experience and knowledge across all functions that are required for the business. Major driver of better multiple, and if actually everything revolves around the business owner, and if unfortunately they got run over by a bus, everything collapses, then that has its own impact on the multiple. So in that sense, it's making sure that the goodwill in the business is corporate and not personal, i.e. sitting with individuals. I won't go through all of the drivers, but other significant ones will be the quality of the revenue stream, and by that I mean typically it's great if you're working in a situation where you've got recurring revenues, and even better if they're contractual. You might be maintaining something. One of the sectors that is very very lively at the moment is kind of facilities management type, and particularly in and around the kind of fire safety sort of, I suppose, both active and passive. But if you're going in and installing a fire system in an apartment block, then there's a capital cost of that, but ultimately you probably get a 5-year contract to maintain it, and that is high quality revenue. As long as it's profitable, that's high quality, because you can see the future there. You've got 5 years worth, as long as you keep fulfilling that contract properly. Whereas if all you were doing was doing the capital installations, then that's great, because it's probably a big ticket, but you're reliant on the next project and the next project, and you might not know when that's coming along. The quality of the revenue there is not as strong. Mm-hmm. So that's kind of what we talk about when we talk about quality of revenue. And then I guess it's slightly connected would be customer concentration. So one of the challenges that we often face with the clients that we work with is that they might have a very nice turnover figure, but it might be underpinned by maybe 2 or 3 large customers, and therefore if you lost one of those customers for whatever reason, that has a significant impact on the business, and that's a big I suppose diluter of the multiple. Okay. So in a perfect world, you're going to have if you've got a £5 million turnover business, you've got 10 clients doing £500,000 each. That's much better than 2 clients doing £2.5 million each, and that's an extreme example. You're probably better off having more than 10, but that's what we talk about when customer concentration risks. So those are there are a number of others, but be here all day if we went through them line by line.
Mm-hmm. So that's interesting, because one of the phrases you hear often is single points of failure. So when you're valuing a business, or if you're a business owner, single points of failure in the sense that you've just spoken about, is the business wholly reliant on the owner? Is it reliant on a handful of suppliers? Is it reliant on a handful of customers? So is that what they mean when we talk about single points of failure in a business, and how can you make sure there aren't any, in a sense, to build the value?
Well, that's what I would understand to be single points of failure. And if you've got one of them, you can address that over time. If you've got more than one, it's going to take much longer, which is why sometimes when clients will come to us, the 3-year window might not be enough. If there's reliance on the owner and there's one or two large customers that have driven the growth, it takes time to, certainly takes time to create and continue to invest in a broader management team that literally again makes the owner redundant, and depending what sector you're in, you can't just go out and create 25 customers overnight. There's a marketing strategy that needs to sit around that. So but that's that's what I would understand to be kind of single points of failure risk.
Yeah.
So when a business owner approaches you, is one of the first things you'll look at when they come to you and say, I'm considering a sale in a few years' time? Would you say one of the key things you look at is how important the business owner is to the running of the business? And would your advice to them be, we need to find a way to almost extract you from the day-to-day running of this business?
Yeah, I mean that depends, John, but I'm going to say that in 80% of cases there's a lot of focus that we would put on that position. Maybe not just the owner, but maybe a small group even of people who don't have any clear succession underneath them or around them. And ultimately in the world of the SME business, which is our bread and butter, the default position of most buyers is that there is a lot of reliance on owner managers, and that's their default position, and then it's down to us to show them that actually that isn't the case, and there is less risk. So that has, if we can't do that, that has two impacts. One, it has an impact on the overall value if we are going through an exit transaction, and two, if there is risk perceived on one individual or a small group, then what you'll see is a kind of a structured transaction. So the headline price for the business might be 5 million, but that might then get split over a 3 or 4 year period, so that the buyer can get comfortable that the risks that sit around these key people will be diluted as time moves on. And so by year 4, if they haven't sorted that out, then kind of ultimately it's on their watch. But that clearly has an impact on the desirability of a transaction for a business owner. So you might be getting 5 million, but you'd much rather have that on day one than spread over 4 years. So it's not just the overall value; it's the structure that might get impacted.
Mm-hmm. So if I'm a business owner and I come to you today and I say, I want to start building my business value. It may be that I want to sell in 3 years, 4 years. It may be that I don't want to sell at all. I just want to, it makes good business sense to have these best practices in my business. What would your advice be? How would you work with the business owner? What would your advice be for them to start working immediately, today, to start building their business's value?
So specifically, how would what would a project with us look like? Yeah, well, it would be, obviously we would want to get under the bonnet of what their desire is, and this comes back to working with Tom and Adam. It's you'll be looking at kind of what do people want to achieve in life, and how much money do they need to have it, and a lot of times that's driven by business, isn't it? So that it's completely aligned with their personal lives, and so we'd sit down and understand what they want, you know, because if they have got lavish desires moving forward, that's going to mean a bigger number than if they're quite happy sort of keeping a relatively sort of modest lifestyle, but you know, just doing the things they like to do, but wanting to do it sort of perhaps earlier than most people, kind of thing. So we would sit down with them and understand that. But ultimately, the kind of the nuts and bolts of what we would do is it starts off with, let's do. We don't want to know where you've come from. Let's do a valuation, a proper business, you know, a commercial business valuation, not a desktop, you know, typical accountants type value. This would look at the external conditions and understand, you know, what transactions are going on and what the future direction of travel is in that sector, and then kind of work from that to where they would like to be in terms of business value, and then there's a gap there to plug. Typically we would work through we call it like an orbit plan. So basically that would move you from where you are now to where you want to be in 3 years' time, and it takes the form of a kind of effectively a one-page high-level summary, and it looks at all the key drivers for that, which clearly would include turnover, profit, but you know, team, marketing activity, systems, all of those kind of things, you know, and each one of those has got a layer. So you start off with year one in this layer 2, layer 3, you know, and just the headline activity that would need to be carried out in each of those blocks to get us to where we want to be, and that's an iterative process, of course, and sitting behind that one pager typically will be a 12-month kind of more detailed strategic plan, which you know, fulfills the strategic objectives, but then there will be activities that sit around that, and then those activities would then be carved up amongst the key people to deliver on, and then we would use that kind of 12-month plan to kind of benchmark and work with the client, typically on a monthly basis, so that they carve out some time so they know they've got that strategic time. And yeah, as we say, you know, as we get to the end of year one, we would then be looking to revisit. Well, we'll be revisiting it all the time, but then you'd be revisiting your overall orbit diagram, and then creating a plan for year 2, etc.
Great. So really interesting. Thanks for that, Jerry. So I'd like to really now come on to Tom and Adam, if I can. And so we've covered the sort of business owner from the sort of corporate finance perspective and what they can do to build their business value. And the reason you guys are here and what you guys are good at is working with business owners and on their personal financial side and their financial planning. So I guess I'll give you the same scenario that I gave to Jerry, which is I'm a business owner running a successful business. I'm perhaps looking to sell in a few years' time, perhaps not. So how would you work with a business owner typically when they approach you in that sort of scenario?
Yeah, to be honest with you, we'd work with a business owner in the same way that we'd work with non-business owners to an extent, in the sense that we try and take the business away from their planning a little bit. It's more around them, their family, what do they want in the future, what are the goals, what are their objectives. Because the business a lot of the time is just a means to an end for them to be able to retire at a certain age, or to have a certain level of income, or a certain lifestyle that they've become accustomed to. So from our point of view, we kind of take the business away from it to an extent, look at them from a personal perspective and say, okay, well, when is it ideally that you want to sell out of the business? Once you've sold out of the business, what are you looking for? Is there big things that you want to do? If you've still got young kids, for example, at this moment in time, what's your present financial situation? And if you want to achieve all these things over the next 5 years, 10 years, 15, 20 years, how much is it going to cost? That's for most people, everyone would want to do all these amazing things. The big issue for most of us is the financial side, isn't it? So as a business owner, if you've got the business to potentially fund that over the next 5 years, 10 years, 15 years, and at some point in the future you've got the opportunity to sell out as well, well, actually the business just becomes a means to an end. The important thing is actually being able to fund your lifestyle, fund the things that you want to do. So we kind of take the business element away from it, speak to them as an individual. What do they want out of the business? What do they want individually? And effectively then use that to say, okay, well, if you're going to need X amount of money over the next 5 years, this level of income, what level then do you have to get to the business to? You know, is there a certain figure if you sold out at £1 million or £5 million, for example? What does that actually give you? Does that enable you to do all the things that you want to do moving forward? And that then kind of from our side certainly influences the business decisions that they make, because as we've spoken about previously between us, you know, it is, if you know selling your business for £2 million, you can do all the things that you ever want to do in your life. The only benefit of selling out for 2.5 or 3 million or £4 million, for example, is you've got more money in the bank, which of course is more security. But actually, it's nice to know that with the £2 million sale, you can do all the things that you want to do moving forward.
Right.
I think, as well as that, all of the principles that Jerry's talked about so far, from a business side of things, apply equally in a personal context. Having the plan, having the vision about where you want to get to, and that's often something that, in our experience, when people come to us, they've not, especially from a business owner perspective, they've been so focused on, this is the business I want to build, this is what I want to do. They've kind of neglected the why.
Mm-hmm.
So for us, we've got to really get back to the person, the motive, the motivation, where you want to get to. Why did you start the business in the first place? And that will influence. So it's kind of all the principles that Jerry talked about, apply them on a personal basis, and then get back to basics. What do you want to get out of this? And then, as Tom said, right, the numbers then will become clearer.
Mm.
We often get asked a question, so people will come to us, and the first question that people will ask will either be, "Is it enough?" or "How much do I need?" And that's it's a fair question, but it's not one that we can answer until we've gone back to
What's your objective?
what's the objective. Yeah.
Yeah.
As I said, some people might look at one value and say, well, that's great, that will do me for life, and I'm comfortable.
Mm-hmm.
Another person might say, well, that's not going to get me through to Christmas. It
Yeah.
depends on your lifestyle, doesn't it?
Mm-hmm.
So it's that's, I'd say, is the principles apply equally both ways.
Mm-hmm. Interesting.
But we don't often come to them.
That's okay.
We don't often come back to them on a personal level, because it's so vital that we run the business, and that's what gets our focus.
Yeah. And you mentioned before, Jerry, about lifestyle businesses. People who own a lifestyle business have got it spot on, because they know exactly what they want out of life. They know exactly how much money they're going to need. It's growth businesses that are looking for a sale in the future that actually tend to, when we speak to them, have no idea what they actually want out of the business. They know from a professional point of view they want to grow the business, they know they want to sell in the future, they want it to be successful, and they're really passionate about what they do, but they've not really got the understanding of, why am I doing this again? Is this for, yes, I'm doing it for a sale in the future, but what's that going to enable me to do? Lifestyle businesses typically have that covered off, because they know exactly what they want, they know what they want their life to look like, and that's something that actually they're very good at.
That's really interesting, because, like I said, the premise of this session was really to think about the crossover between a business owner running the business and also thinking about their own personal financial situation. And it strikes me that we often talk about cash flow in a sense of a business, and most business owners will know about cash flow forecasting and that side of things. It's interesting to me that there's clearly an element of cash flow forecasting, but from a personal financial perspective. Is that something that you work with your clients, and how would you do that if you were going to do that?
For me personally, I think it's probably one of the most key parts of what we do, because effectively what cash flow forecasting does is visualise for someone what potentially their life is going to look like in a number of different situations. So we take some of the financial information in terms of their assets, their income, the different wealth they've got, and then what we can do using the system and software is effectively show them, if this was to happen at this point in time, so for example, if you sold your business for £1 million on this date, this is, using a data-driven approach, this is what we think your life could look like in terms of what income you could draw, what your assets would be worth, and whether you could tick off all of those different goals that you've got. So in terms of, can I send the kids to university and fund that for them? Can I be able to retire at a certain age and kind of continue my lifestyle? The forecasting allows us to show them that visually, which is really important. but also shows us different situations. What happens if you don't sell the business for £1 million? What happens if actually the sale doesn't go through at all? What impact's that going to have? And what impact is it if you actually grow the business to a sale of £2 million, for example? Is that actually going to have a tangible difference on your life? And if it is, here's the figures in terms of how much more you'll have in terms of wealth, how much more you'll have in terms of the different assets behind you as well. And that just helps inform decisions, because we'll show someone scenario A and they'll go, well, actually, I'm really comfortable with that. If my life looked like that over the next 10 years, 20 years, I'd be absolutely delighted. Well, if that's the case, why are you trying to grow your business to double scale up and double the size of the business if you're happy with the outcome that you can have today? Or on the flip side, you'll have some individuals who go, okay, well, it looks okay, but actually what I would now want to do over the next 3, 4, 5 years is I want to look at that scenario B and understand how can I get there. And again, that's where Jerry and yourselves come into it is, okay, well, if we need to grow the business to a certain size, to a certain level, to a certain valuation, what do we do over the next 2, 3, 4, 5 years to make that happen?
Mm-hmm.
The other thing that Cashflow really helps with, or this kind of cashflow analysis and visualization, it helps to put out there and really demonstrate what those potential single points of failure are as well. So coming back to what you were talking about is, if the plan in my mind is that in 10 years time I want to do X, well, that from a personal perspective is a huge single point of failure, because there are external factors. We can run a successful business and then in 10 years time be in an economic environment that doesn't support that valuation.
Mm-hmm.
So again, it helps to really start to protect people and plan for all scenarios just by showing them, visualizing it and seeing, okay, well, it's the what ifs, it's the kind of what happens if this doesn't materialise,
Mm-hmm.
or what happens if it goes better than planned or worse than planned.
Yeah.
That's interesting. So we talked about with Jerry. Jerry covered some of the best practices for business owners, to build the value of their business over time, whether they want to sell or not. When you're working with a client, a business owner client, are there any best practices that you would be suggesting they do every year, rather than, obviously leading up to sell, there might be things you might recommend, but are there best practices they should be doing on a yearly basis? What would you be recommending to them?
There really are. So again, when Jerry's talking about building the value and what the factors are, none of that comes down to having money in the bank, having money in the business, because that doesn't, to a large extent, it doesn't increase the value of the business. That's about revenue. So what we find is people will often try and, if they've not received advice or they've not gone to take, to seek professional support, there'll be a sort of a general assumption that if we're successful and we keep building money in the business and generate funds, and that's kind of adding to our security and our long, well, that's a potential that they're leaving value on the table. We're not taking it. So on an annual basis, you should be looking at maximising allowances, tax allowances, whilst they're there, whilst they're available. So things like pensions that Jerry's talked about, tax relievable opportunities. So we'll probably talk about it later, but things like protecting business continuity can often be a really tax efficient thing to do. So again, it's about, absolutely every year we should be sitting down and looking at it and thinking, what allowances, what tax efficiencies can we make, and make use of them year on year, because the rules change. So they might not be there next time.
Yeah, and again, it all comes down to reviewing your situation, doesn't it? It's, again, Jerry mentioned before around how quarterly reporting is better than annual reporting because you can see an issue. It's the same with a financial review. It's if you don't look at your personal circumstances, don't redo your cash flow forecast, and don't look at your financial position every 12 months or even every 6 months. A lot can change in 2 years and 3 years when you go, pick up my plan, look at it again and realise actually we're miles off track, nowhere near where we need to be in terms of retiring or meeting your goals. Mm-hmm. And that comes down to the fact that you haven't bothered to look at it over the last couple of years. So similar to your reporting with the business, we always say to clients, sit down with us or sit down with your partner or individual basis once or twice a year, have the conversation of, right, this is what's happened, this is what's changed in terms of my life, this is what's changed financially in terms of my goals, and kind of realign and make sure that you're still on the right track. So it's just about keeping on top of it as well.
That's really interesting, because we talked about the synergies between running a business and sort of running your own personal finances, and you're right, Jerry talked about management information and having those regular reports and checking the key figures in your business, financial and non-financial, and it strikes me that it's exactly the same. You're saying it's exactly the same on the personal finance side. You should be almost having a management information for yourself, if you like.
Yeah.
Is that true? Is that something that you do with your clients?
Absolutely, yeah. It's about goal setting and planning for those objectives. So yeah, absolutely. Every business owner will have their sort of annual KPIs, their business plan, their 5-year plan, and their kind of longer term vision.
Mm-hmm.
If you ask those same people, and they could articulate that, most people, who are running effective business could articulate that. You ask them on a personal basis, well, what's your 5-year objective? Where do you want to be in 10 years? Not many people can articulate that very well because we don't spend time thinking about it, and that's what we would encourage people to do. Yeah.
So Jerry, I'd just like to come back to you to ask you about finance raising, because clearly we've talked about building the value of a business, and I'm interested to understand, clearly if you want to grow your business, you're going to need some finance. Often you're going to need some finance at some point, and I know that it's a lot of the work you do with clients is around raising finance. So are you able to talk through simply, I know that's probably not that easy, but are you able to talk through the different options? There's equity finance and debt finance, what those options are, and in your experience, what are the benefits or disadvantages of those?
Okay, so I guess most people will be familiar with the concept of debt finance. We may all have had loans at one time or another, and clearly in the context of the business world, then the significant debt funding available, and I guess it's historically it's always been available for the large corporates. In our experience, it's always been much more difficult to access, with our client base at the kind of the SME level. We've always had to put robust plans together and cash flow forecasts that indicate that any debt that you take on can be serviced by the business. But ultimately, it's simple in the sense that it is most people's default, because you've got you retain, you're not selling any of the equity in the business, so you're retaining the ownership structure that you had before the debt went in, and therefore you're retaining full control. It is a product. Typically sort of structured debt is a product, or senior debt is a product, and therefore you're signing a contract or on a term sheet that says you have to pay X amount of capital back and X amount of interest, and if you don't, you're in default, and there are certain kind of remedial action that can be taken by the finance providers. So you've got that kind of that risk element, but ultimately it's what most people know. It's probably the cheapest form of funding, and by that I mean you'll get whatever the rate is, X% above base rate, and that's the cost. We'll talk about equity finance in a minute, but if you sell your equity, that's you're parting with something that could be hugely valuable in the future. So debt is the cheapest form of finance. It comes in other forms nowadays. We see a lot of traditional kind of senior debt, but also asset-based lending is so many different providers now, all doing a number of them doing very specialist things. So from invoice discounters who are funding against people's debtor books. Typically, you took your whole debtor book and there was a percentage that you could raise against it, etc. And now there are some specialist funders who will go in and they'll fund individual significant invoices. They might fund certain sectors that historically have been difficult to fund. So there's much more choice, but the security there is the debtor book, and then other assets that you may have. So fixed assets, again, you can raise funds against those, or clearly you can buy funds using some HP agreements and other similar functions. So I think most people are quite familiar with debt and the way it operates. Probably more interesting in the sense that it's less understood. I would say by the marketplace is equity type funding, and we, for a small firm working with relatively SME type clients, we've got significant experience in terms of raising equity finance for those businesses, and therefore I guess we can talk with some knowledge about it and probably dispel some of the myths, in the sense that, again, historically, equity funds had a reputation whereby they might take control of a business, and as soon as they've got control, make all sorts of changes and perhaps dispense with people who've got the business to that point. Well, in our world and in our experience, and the funds that we're aware of, that doesn't happen. Because they are in large kind of private equity investments, then you are investing in large corporates where people can change. The positions remain, but people can say. So in the organisational chart, you'll have a position, whereas in smaller businesses, you'll have somebody's name because they've been there and done it and done it forever. So the point of what I'm trying to get at there is that the funds are still investing in people at SME level. So they are typically going to want to support and manage and help manage, but it's much more of a partnership approach, and the funds will range in size from or type from being very hands-on, if you want them to be, and supporting and giving general advice, but they might be able to open doors for recruitment or bringing on new customers or suppliers or other techniques, to kind of very hands-off, and basically, yes, we'll invest in you. We've done our due diligence. We want to put the money in. Yes, we probably take some kind of observer's position or seat on the board, but unless you want us to be, we'll be very kind of light touch, and that appeals to businesses too. And if you deliver what you say you're going to deliver, we've seen that outcomes where everybody's happy. So ultimately, so that would be kind of, I suppose, the sort of institutional type investors, private equity type investors. So they put money in and they get a stake. So the upside of that is that it's kind of low risk, because you're not taking on debt and debt that needs servicing. So it's more patient capital in that sense. It is a partnership, so your goals are aligned, because ultimately they're investing to get a return on that investment, and you want their money to grow the value of your business. So you're aligned in that sense. And one of the things that I should say that in our experience it does underpin sometimes a higher multiple than a business that hasn't taken equity money, on the basis that the market has seen that a business has gone through a full due diligence process, and it kind of does what it says on the tin to that extent. So therefore the market's got confidence that the business could stand up to scrutiny. So there is that as a kind of a side benefit too. I mean the obvious downsides are you don't own as much of the equity anymore, but it's the whole kind of principle of, well, how big is the pie? So if you own 100% of a small pie, that's great. But what if you own 60% of a much bigger pie, and that might be that might mean a 20 million business instead of a 5 million business. So those are the factors to weigh up. But in our experience, it's a legitimate alternative to debt for most businesses. And what we have seen then, therefore, is kind of is a growing market for sort of a hybrid. So what we would call mezzanine type funding. So it's sort of it's got characteristics of both debt and equity, and again, by its very nature, you can't define it because it comes in many shapes and forms. But typically, you'll take a sum of money from a mezzanine provider, and that might it might look like debt, i.e., you know, it sits as debt on your balance sheet, and you might take £1 million, say, but you know that would be structured in such a way that you might be able to roll up interest, i.e., you wouldn't have to pay it as it fell due. You might be able to roll up capital payments, and sometimes you know you can sit there until you know it goes in on day one, and it might come out on at the end of year 5 when you exit, and all of the interest and capital is repaid then. So that's you know that's kind of quite a nice option because it gives you a bit more flexibility and support around running the business. Sometimes those types of funding providers might ask for a small slice of equity or the option to buy some equity at the end of the process. So you've got to be aware of that, but it would normally be only a thin slice of equity. But again, it's you know, others will sort of say, well, we'll have a bullet payment at the end, which means you know we'll have a you know, yes, these are the financing costs as we go along, but then we'll have an extra chunk as a bonus, and you know sometimes that might be lower if you can repay it earlier, kind of thing. But it's you know there are all sorts of options around now on the funding side, and you know we're relatively well placed to you know to access most of them for you know our client base and our you know the kind of the market that we're operating in.
Great.
Is this the time to talk about partial sales, or when?
No, we'll do that in a second.
Right,
That's
okay.
right. Thanks. So I'm just interested, before we move on to the actual exit, selling the business or another exit, which we'll come on to. When you're, Adam and Tom, when you're talking to your business owner clients, clearly we mentioned at the start that you know your personal finances are inextricably linked to your business. What sort of conversations are you having with your business owner clients about the performance of their business? I mean, clearly that's not the side that you advise on, but what sort of conversations would you be having with them over the years with regards to their business?
Yeah, I think from our side we always need to have an understanding of the performance of the business, because firstly it links into the planning, so the long-term planning, and what they're trying to achieve is going to be, a lot of the time, is going to be funded and as a result of the success of the business. So we need to understand how is the business operating, etc. On a short-term basis, we need to know things like, for example, what cash reserves have the business got? Is there any big capital outlays that are coming in the business in the next few years? Because, again, when it comes to, you know, for a lot of business owners, it's not just about the actual end event in terms of the exit, it's about the profit extraction as well. So if over that 5-year period building up to the business sale, over 5 years, you know, you don't just want to sit on what you've got in the business and kind of rest on your laurels and go, yeah, I'll be fine because 5 years down the line I'm going to sell the business and then I can walk away into the sunset. The 5 years before then, or whatever amount of years you've got before the business sale and that you're planning towards, you need to make sure that actually during those years we're having conversations with owners around performance of the business, what capital you've got within the business, so that actually you can extract from the business efficiently, because as we know, not every business gets to that point of business sale. So if you've had a successful business over the periods of 5 or 10 years and you're solely reliant on a sale at the end, sometimes for some individuals that time doesn't come. So it's really important that every single year, again, once or twice a year, you sit down and have an understanding of how can we draw funds from the business, how do we do it tax efficiently, because the business sales isn't always at the end of the rainbow, unfortunately, is it?
Great.
And there's a practical element as well in terms of understanding the context of the performance of the business. Where does that performance come from? And it was mentioned a little bit earlier by Jerry around, is that the business owner themselves? Is it key people within their organisation? Because again, if we're talking medium to long term planning, we need to understand what are the risks. What are the risks to your personal position? So by that, you're thinking about, well, if there's an individual in the business and that's me as a business owner and I'm integral to our success and our revenue generation, then I'm a potential point of failure again. So what happens if I can't fulfill that role? What happens if I've built a business team around me and I'm reliant on these several people to do the same? Again, that's important from our point of view to understand that, so that you can build in plans around it, protection plans, things like relevant life, key person insurance, which again are tax efficient potentially, but not something we always think about because we're so focused as business owners on the success. We don't want to think about what happens if, you know, if the worst happens. And again, there's a link there to even more important potentially for family businesses, because things like shareholder agreements, shareholder protections, where everything's rosy when it's rosy. If something happens, often that's when arguments, tensions arise, and that's important to think about. But people don't typically think about it when everything's going well. So from our point of view, it's about we want to understand the performance, where it comes from, and how we protect that. So there's continuity.
Great answer. So I'd like to move on then. So I'm a business owner and I've been running the business for several years, and I've finally decided, yes, I'd like to exit, whether to retire or try something else. I'd like to ask you, Jerry, really, because this sort of on the corporate finance side is your area of expertise, really. As a business owner, I'm going to exit. Are you able to give me an idea of what the exit options are available to me? Because everyone will be sat there thinking, sell the business, but what does that actually mean? What are the exit options available?
So, I mean, I suppose the best known would be a full exit. So, you would sell 100% of your equity to either a trade buyer, or much more common these days, a kind of financial investor. So again, it would be a private equity company that has got an investment in the space in which your business operates, and they might bolt on your business to their existing. So that's as simple as working with our clients. We're working with them from sort of day one, trying to position them in the marketplace so they look attractive to the right kind of buying cohort, whether that's trade or private equity. Those are the kind of things that you should be thinking about from a very early stage. But ultimately, then that's a relatively simple process in the sense that you find the right buyer, maximise the value, and go through a process. That makes it all sound very easy. That take even when you've kind of worked with the client along the way, that can be a sort of a 12-month process. But that's kind of that's how it works in principle. There are kind of much different options whereby you could sell your business to the management team, for example. So if you're a business owner or husband and wife team, but you've got a really good team of people that helped you grow the value, and they have shown an inclination to take on the leadership running of the business, then that's kind of a very mutually beneficial and attractive way to go. Not least because the risk in that situation should be low, in the sense that the sellers obviously know the buyers very well, and vice versa, and so it means that from a funding perspective, so if external funds are required to help finesse the transaction, the risk is perceived as low to those funders. Therefore, A, there are more funders who are likely to want to be involved in the transaction, and B, it should come at a better price for everybody. So in that sense, it's attractive. Also, clearly, if you are marketing a business for sale, whilst everything revolves around confidentiality, there is still the risk of leakage if you're going to external parties and sharing confidential information with them. In a management buyout situation, that isn't the case. The management team typically will know most things about the business, and that is the assumption. It should be a relatively sort of tight, swift process, much swifter process than a trade sale type process. So other things to consider there, though, would be often there's a structure around that, in the sense that the sellers will be prepared to accept payment over time, and that helps the management team be able to afford to buy the business in. It's not as crass as this, but so basically they can use future profits to help fund that transaction. So that is another, a common, much more common in a management buyout situation. Owners would be prepared to do that. I mean, from their side, they can often drive a slightly higher value over a period of time, because if they accept a 5-year timeline, the time value of money, they might expect to get a little bit more than if everything was paid up front. If everything was paid up front, it's fair to say that on balance you'd probably get a lower value than you would in the trade market, but ultimately there's a trade-off of the risk of so certainty of a transaction happening there. Mm-hmm. I suppose one downside is if a management buyout goes wrong, which thankfully has never happened to us but has happened, it's a difficult position to be in, because you've now got a situation where potentially relationships have strained, and particularly from a sell side, you've now got potentially a disenfranchised management team. So that is a risk. As I say, if it's managed correctly, if it's not likely to go ahead, you should never really get into the process. It should all be sort of understood at the front end, really. So
something else that we've seen a lot more of in the last few years would be partial sales.
Yeah.
So I think a lot of business owners, when they're exiting, might think, oh well, I'm selling, I have to get rid of the whole business, but that's not always the case. Could you talk us through what a partial sale might be and what they look like and how you'd help?
Yeah. So again, I mean, we've done a number of these or several of these transactions. It's not a volume. We're not a volume operator, but that's a really good point to raise, John, because there are options beyond carrying on trading or selling, and sometimes business owners will get to various kind of milestones in their journey, and they kind of think, well, I can't take this business any further. I probably haven't done everything I want to do with it. I probably haven't got to the value that I would like, but I've got no alternative because I can't grow the management team. I've got something else that's stuck. I can't grow the customer base, so I'm going to have to sell even though I don't want to. Well, reality is now, the business needs to be of a certain size for this to be attractive, but there are opportunities for partial sale using equity type partners, whether it's a formal institution. There are a number of kind of smaller groups, unofficial type investment vehicles that have formed together. So you could have a situation where you would sell, let's say, 40% of your business to an institution at a value, in our experience, very sensible valuation. That kind of, to use a phrase, would de-risk the business owner. It might not give them everything they want to go off and talk to Adam and Tom about the whole life plan, but it certainly might enable them to pay off the mortgage, make some investments, put something aside for school fees, university fees, those kind of things, but also helps build the platform to have the full exit that they might have aspired to 3 years before they got frustrated. So again, all of those things we talked about with equity partners before, we've seen where they've helped come in and they've helped form a management team, bring customers on board that have been difficult to do previously, and help move towards a much bigger exit down the line. And it doesn't kind of have to end there, because there are kind of further exits that you could have, or partial exits that you could have as you move towards the end game. And for certain individuals, they might want to cash out at certain times when others don't. So it's quite a good way of trying to align everybody's interests if they want to do things at different times. You might have one shareholder who's got 20% of the equity who does want to go off and do something else now, and you can help them do that. With a partial sale to institution or similar. So it's a significantly growing and valid alternative, and I feel that not enough business owners who would benefit from it are aware of it. So it's certainly something I think we'll see become more prevalent over the next months and years.
So, as a business owner then, Jerry, is there a best time, when is the best time to sell my business? Is there an optimum time to come to Leon Herman and say, right, I'm ready to sell?
But, I suppose apart from the crass, when somebody comes along and says, I want to buy you at a stupid price, which never happens, of course. The best time to sell is when you've delivered your plan and everything's worked perfectly, and you've hit your 25 million valuation at the end of year 3, and you've already done all of your work with finding who the right buyer is, and that happens, but will only happen. It won't happen by chance. That happens with kind of careful planning, and that's you work back to the start, which is where we came in, isn't it? Really.
Would you be looking at market conditions, though, for example, when deciding when to sell?
Well, of course, and so the perfect time is your 5-year plan and everything's gone as per the scenario. But ultimately, there are iterations around that, and specifically, if somebody generically came to us now and said, I want to sell my business, we would probably ask them to sort of reflect on things like market conditions, because in our view, multiples have probably gone down by a point over the last 18 months or so, just across our client base. Well, we've seen that because we're working on transactions all of the time, so it is, it's a really good point, that, but perfect world, perfect scenario is you deliver your plan on time and get the number you want, and
okay.
So Tom and Adam invest it wisely, and
ideally you get that phone call with the offer.
Yeah.
So I suppose one final question on this exit for you then, Jerry, would be Leon Herman. Then, if someone came to you and said, I want to exit, can you just, I know it's a complex process, but if you were able to condense it down to what you actually do for a client when they want to sell their business.
So the actual transaction process itself. So we would work with the client, produce an information memorandum, which effectively is a prospectus for sale. It would cover most key points that most buyers are going to want to look at. Again, we're working with SME businesses who, we're not going to be able to provide everything to everybody, and certain buyers are going to have different requirements. But in essence, we would produce that document. If it kind of depends what type of sale it is, in the sense that if it's relatively closed, i.e. we know that there are half a dozen, we've done all the work, we know there are half a dozen players, then we would get that information out to them once they've gone through all of our confidentiality requirements, and we've understood how they're going to fund a deal, etc., etc. And then we would want to keep the process open amongst those interested parties for as long as possible. As soon as you kind of move to an exclusive process, then obviously that means you're only working with that one buyer. But and then that process would look like they would have information requests if they were sensible and reasonable, and they were at the right time in the process. I.e., you wouldn't give somebody a customer list on kind of day one, but you might have to towards the end of a process. Then we'd work with them, get them to a point where they can then put an indicative position together. In an ideal world, we would take the best 3 offers forward, and that doesn't always mean the best price. Sometimes it comes back to structure. Sometimes it comes back to other things like, are people going to be looked after? It often will depend on the history of that particular buyer in transactions, both in terms of completing transactions and also completing them at the price that they went into them at, because you don't want to be kind of going through a due diligence process and having your price chipped. But ultimately, get your 3 best offers on the table. You will have to eventually select one. With that one, you probably do further due diligence. Obviously, then you've got the legal aspects. That whole back-end process, from selecting the right buyer to going through remaining financial due diligence, legal due, other types of commercial, environmental, etc., probably takes 3 months. And our job in that period is to protect the value, and then ultimately sign off on all the legal documents, and you know, with as few warranties and indemnities as possible, and the best structure that we can get. But that even when we've been engaged, as I've said, it can we've been engaged for a period, it can take up to a year. But in an ideal world, that's a kind of, you know, if it's quite a tight process, that's 6 months. If we've got a bit less idea about where the buyers are, then that's going to take a bit longer, and the buyer finding element of that takes a longer period. So 6 to 9 months in a well-run process.
Great. So moving on then to the final part of this masterclass. So I'm a business owner, and I've finally exited my business, however I chose to do it, and I've now got a nice lump sum, and I'm coming to Adam and Tom, and this is where you guys would come into your own, I guess. So I've just sold my business. I've come to you with like I said, a nice lump sum. How are you guys going to help me? What questions will you be asking me?
Okay. I think, ironically, the questions we'd be asking would be the same questions we would have asked you if you'd approached us 5 years ago. Is more about you, more about your personal background, financially understand your position as well. And again, what over the next 5, 10, 15 years from now, what is it that you want to achieve? Have you just sold out of the business to actually fund a retirement? Have you sold out of the business because you want to use the capital to invest that into another business? Do you want to spend some time with the family? Do you want to put the kids through university? All those types of questions will be exactly the same as they would be 5 years ago. It's just you're in a slightly different financial position. So the planning element then will be a little bit different. So from a questions point of view, very, very similar. There would be some additional questions around tax efficiency, for example. So understanding what the capital gain was on the sale of the business, having conversations around tax efficiency and how we can actually factor that into the planning as well. But typically speaking, very similar conversation. And then in terms of how we can help them move forward, again, will be the same as the solution 5 years earlier, in the sense of we will now help you achieve your goals moving forward now that the business sale has been completed. And that can be done through a number of different ways in terms of investment vehicles and savings vehicles, for example. But the actual premise of what we will be discussing and why remains the same, whether you're at the start of the journey or you've actually hit the jackpot, I suppose. So
when you're considering an investment strategy on my behalf for me, what are the sort of I don't know if you call them products, but what sort of options would you be looking at or recommending to business owners?
So there's a whole range, and I think, again, coming back to what Tom said, the starting point is always objectives, feed the strategy then informs the products, as you put it. So there's a whole range, and it will depend on the strategy and what we're trying to achieve. You've got anything from pensions that have been mentioned. You've got so some of the sort of generic, sort of fundamental planning tools are pensions, ISAs, investment bonds, unit trusts, and they've all got different features and benefits and uses, essentially, because they are all just tools to achieve the plans and the objectives that we want. So they're the kind of the generic things. Then there's also more tax efficient or tax focused solutions, things like venture capital trusts, enterprise investment schemes, and also business relief schemes if people are talking about inheritance tax. So there's a really wide range. Which ones you deploy at which time will be dictated by those conversations that are, where do we want to get to, where are we now, where do we want to get to, and then that's our job to kind of put that solution together for you to say, well, this is the most effective way to get you from A to B.
Yeah. And that sometimes is the more complex element, because people typically we don't understand what allowances have we got, what's going to be most tax efficient, when can I access different savings, different investments. The approach me and Adam always take, and try and keep it as simple as possible for a client, is something called the 3-pot approach. So in effect, splitting out the capital off the sale of the business into 3 different needs. So first needs would always be an immediate access fund, so for emergencies effectively. How much does the individual want in cash at all times, just in case the roof caves in, the kids come running to the bank of mum and dad's, the car engine goes whilst you're on the motorway, so just in case. So that goes aside, pot one. The pot two, in terms of the purpose of what you need some of that capital for from the business sale, then would be immediate expenditure. So over the next 5 years, what do you want to spend some of those funds on? So it could be you want to renovate the house, pay off the mortgage, give some money to the kids, for example. They might have a big holiday plan to treat themselves. Over the next 12 months, 2 years, 5 years, what do you think you're going to need some of the capital for from the business sale? Again, that goes aside into pot two. We put a number on that based on the conversation we had with an individual. The third pot then is what Adam's alluding to. We call a medium to long term pot, which in effect is, this is money we don't think we're going to need from a capital perspective over the next 5 years. This is the money that actually is going to provide us with the income we need in the future, and that's the money that we start to look at some sort of investment strategy with then. So we try and keep it as simple as possible with people in terms of what do you need the money for, split it out, and then it's that pot three that actually sometimes is the complex one. How do you best manage that money? How do you best invest that money? What level of risk is appropriate? How do we be tax efficient? And most importantly, when it comes to the future, how do we access it for income, and how do we access it for big capital expenditures, 10 years down the line as well?
That's a brilliant answer. You mentioned something there about enterprise investment scheme. Is that something you focus on, or is that could you explain that scheme a little bit more to me as a business owner?
Yeah, so they are so an enterprise investment scheme is a very specific kind of type of investment and a tool that we can use in the right circumstances. It's essentially investment into a very early stage company or number of companies. So the idea is that as an individual investor, if I've got capital to invest, I am incentivized to invest in early stage companies. It's a way of stimulating the economy and growth essentially. But for me as an individual investor in an EIS, an enterprise investment scheme, I can invest up to £1 million, and if I did that, I could get 30% of that investment back by way of tax relief. So there are conditions around it and rules and things that need to be adhered to, but that's the basic premise of it. I can invest into a relatively high risk investment, and the reward for doing that is tax relief. It's money back on my investment. So that's kind of how it works, and there are limits and rules, but they can be really effective for a business owner who has a capital gains tax liability. An EIS allows somebody to defer that capital gains tax payment to the point at which they kind of get rid of that investment in the future. So it's a good way of kind of rolling that on and being able to kind of make the most of your money before you essentially pay that capital gains tax.
And how much influence so if I'm the business owner that's got this lump sum and I think an EIS is a good idea, how much influence would that person have on the business that they're investing in, or would they not have any input on the day-to-day?
It depends what approach you take to it. There are businesses out there who put together enterprise investment schemes that you can invest through, and they will select certain businesses that qualify for that. Equally, as an individual, if you want to just go out and invest into a small enterprise that, based on government rules, you felt qualified for EIS relief, then absolutely you can go down that route. Obviously, the issue in going down that route is there's far less due diligence. You're completely at the peril of your own decisions, I suppose. There's organisations out there, EIS organisations, who will actually do all that due diligence for you, select companies they think are suitable and adhere to the rules. So that, from our perspective, that would always be the route to go down, because it's a safer route if you like. And you've got in that case you've got a little bit of influence in the sense of you can start to look at what's available on the market already and almost select industries, sectors that are potentially more interest or less, or not to you, or more. You might think there's more growth potential in that industry than another. So there are ways of doing it, but I think that for an everyday individual, I think that route of looking at it in a managed way is probably going to be far more appropriate and secure for an individual. Yeah.
Okay. And you also mentioned something called a VCT. Could you explain what a VCT is? Yeah,
it's a very similar investment to an enterprise investment scheme. Offers 30% income tax relief on any investment that you make up into that. You can invest up to £200,000 into it as well. From that, you can realise tax-free dividends as well. So again, if you're an individual who maybe has crept into that high rate tax bracket or an additional rate tax bracket on the back of selling the business and the income that you've taken from the business in that tax year, really efficient way of claiming back some income tax relief and actually paying yourself a dividend in the future once you've sold the business, free of any tax as well. Where it differs slightly from an EIS is a venture capital trust is effectively a pool of different businesses. So rather than just investing in a small handful, you're invested in 20, 30 businesses at one point in time. Invested in that pool, you've got multiple investors who will put money into that pot, purchase the venture capital trust then. So it's deemed to be lower risk than an EIS, but is still akin to someone who's probably got an upper medium attitude towards risk overall.
Great. And then I suppose finally, I think as someone who's got this large lump sum or looking at investing, inheritance tax or leaving stuff behind for your family or whoever it might be is obviously a big consideration. So I appreciate this might be a little bit controversial for some, but as you're in your role as planners, financial planners, how might someone reduce their inheritance tax liability? What would you be recommending to them?
Again, just by way of context, it could be viewed as controversial, but the fact is, if somebody is liable for inheritance tax, it's a 40% tax, death tax. So there aren't many people that are comfortable sitting back once they've been made aware of that and thinking that's fine. We'll happily lose 40% of the family estate for the sake of not doing some planning. Mm-hmm. So there are absolutely legitimate, perfectly reasonable, sensible ways of mitigating that and arranging things. So often people's first approaches are well, let's give everything away. If my estate is of a size that I'm going to inheritance tax, I obviously have to give it away. And one of our kind of first ports would be to say, hang on, take a second. You don't have to do that necessarily. There are other ways of arranging investments. I don't know if you want to give an oversight.
Yeah, and I think from the investment point of view, there are, we talk about standard investment ISAs, pensions, for example. Some of those are not inheritance tax efficient at all. So ISAs, for example, not efficient when it comes to inheritance tax, form part of your estate. Pensions, on the flip side, pensions are extremely valuable assets when it comes to inheritance tax planning, because typically they're deemed to be outside your estate. You've also got different types of investments that you can put into trusts. So investment bonds, for example, can be put into a trust wrapper, and typically you can retain control of them. You can take an income from that investment as well, and part of it can actually fall outside your estate for inheritance tax planning. So it comes down to what the individual's goal is. If the individual's goal is to actually maximise their wealth, continue to grow it, take an income from it, and this isn't something they're concerned about, not a problem at all. We put a strategy in place to suit that. What we tend to find is individuals, as they start getting a little bit older, into the 60s, into the early 70s, they start to then realise, actually, especially if they've had a business sale in the past, I've got a large estate, I've got a big property, and actually 40% of this is going to be lost to the tax man. Not something I feel comfortable with. So actually that's when then they sit down with us and say, actually, the investment proposition I've got, do we need to alter this to make sure that some of that now is falling outside of the estate? And sometimes it does involve gifting to the kids and the grandkids, for example, or leaving some money to charity. Again, can be an efficient way of actually mitigating your inheritance tax liability. But ultimately it comes down to the individual. There's options available out there that you can take advantage of. And with inheritance tax, as long as you've got enough time, most of the time the tax that you pay can be mitigated. It's just around having the foresight and the longevity to say, actually, I want to do something about this, and sitting down with someone who can help you.
Great. So I suppose we started off this masterclass by talking about how as a business owner, your business performance and your personal finances are inextricably linked. And I think as we've had these discussions, that's what comes across very clearly. I think we also said that in our work with our clients, we often see that when they do come to exit, and they get up to that point, that they if they're not thinking strategically about their personal finances, but also about building business value, that they're often leaving a significant amount of value on the table. So I'm going to take it right back to the start, if you like, before we finish. And I'm going to ask all of you a simple question, and that question is, if I'm a business owner now and I'm running a relatively successful business, But you're saying to me, start to think strategically about building your business value and your personal finances, your wealth. So Jerry, from a business perspective, as a business owner, what are you saying are the key things I should start doing today to ensure that I'm building my business value strategically?
Okay, well, I think the first thing to do is to take a step back, look at things strategically, and you need to understand the value drivers within your business and get them measured.
Mm-hmm.
So essentially, objectively look at the current position and where you stand now.
Mm-hmm.
Because without that, you don't you've got where you start from. It's quite hard to get to where you want to go to.
And when you say value drivers, you meaning specifically those elements that go into the multiple and the valuation?
Absolutely, yeah. So we talked about. So we'll reiterate. How important are you and your team to the business? Because if it's very important, that's great day to day, but strategically, we've got to do something about that. What do your quality of revenues look like? Are they? Is it all spot? Is it you don't know where your next one's coming from? They're a nice big number, but you might go 3 months without. Or have you got a very clear view into the future? You've got drumbeat recurring revenues for 5 years, and then they replenish. Are you beholden to that one great customer that helped you grow your business? Fantastic, it took you from 1 million to 5 million, but now they're 80% of your sales, and actually you've heard through the grapevine they've been talking to somebody else. So those are the things. Understand those and address the ones that are addressable.
Mm-hmm. Great. And I suppose Adam and Tom, from your perspective?
Actually, funny as Jerry says, that is for yourselves and Leon Herman and accountants in general. It's understanding where are you now. For us, it's actually understanding where you want to get to. What's the end goal is probably most important. That is always for us the starting point is where do you want to get to, and then we work back from there. Okay, where are we today, and what actions do we need to make over the next 2 years, 5 years, 10 years to help you get there?
Yeah, I'd completely reiterate and support both of those. I'd say the key for me is on a really practical basis, carve out the time to do it. So as business owners, it's easy and fair to say I'm so busy and I'm at full tilt running my business, but treat this as part of your business. Carve out the time to actually address it, seek advice from the relevant people and areas that you need to, and build that personal plan alongside your business plan. I think they're the key steps that I would suggest.
Yeah, great. Well, thank you so much for your time. I hope all the business owners who listen to this or watch this have got some serious value from that. They start building their business value strategically and their personal finances as well. And if they've got any further questions, we will make sure that your contact details are available, and please get in touch with Leon Herman or Reflect Financial. Thanks very much, guys.
Thank you very much,
John.
Thanks,
John.
Jerry. Cheers.